Too many people associate retirement with the end.
I figure it'll be a little bit of a transition to try to slow down a little bit.
The number one question I have about retirement is having enough money to last.
In my mind, you start to look at it, that's an opportunity to do more of the things you want when you want to do it.
Make it financially able to do things that I enjoy.
Party.
Just financial security and enjoy my family.
More people need to go into it with their eyes wide open, understanding what is my plan, what do I want to do, and then how am I going to get there?
Will the rules change?
I have no real specific plan.
I'm planning for what the status is right now. I just hope it doesn't change drastically.
Welcome to the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona. In retirement, it's all about income. And today, you'll hear ideas, concepts, and strategies designed specifically to generate reliable retirement income. Now, here's the host of the RetireTastic Show, JoAnn Regan.
As you well know, inflation is a major concern, and there are two schools of thought right now. Is it temporary or is it permanent? Depending on which school of thought is correct, could be either very good for your portfolio or very, very bad. And it's an interesting thing that I have been mentioning to people that have come into my office. Hardly a conversation goes by that we don't talk about inflation. So welcome to the RetireTastic Show, powered by the Retirement Income Store. And I'm your host, JoAnn Regan, where my goal is to help you have a fantastic retirement. And today our topic is reflation. Nope, you didn't hear that wrong. R-E as in R-E-flation, reflation. And I know it sounds a lot like inflation, but it's a little bit different. And I'm going to give you the definition of reflation. Reflation is a fiscal monetary policy designed to expand outputs, stimulate spending, and curb the effects of deflation, which usually it occurs after a period of economic uncertainty. Does that sound familiar? Or it can occur after a recession. The term may also be used to describe the first phase of economic recovery after a period of contraction. Let's talk about it. So when we came out of the 2008 debacle or the crash, whatever you want to call it, we had a tremendous amount of quantitative easing after that. I don't know if you can really put any common denominators together, but ironically, the 2008 first stimulation package was started by Republican President George Bush. If you remember, he bailed out AIG, the insurance company. Then Democratic President Barack Obama took with it and ran with it again, and it sounds again very familiar to what was dealt in March of 2020. The very first stimulation package put out by Trump, and then Biden is taking it and running with it. Now, I will tell you, if we hadn't had that stimulation package back in March of 2020, we would probably have been in a world of hurt. Interestingly enough, I parallel the two together. I wasn't 100% sure if we were going to have inflation because when we came out of 2008, with a tremendous amount of quantitative easing, there were 6 or 7 different QE policies initiated. The bailout of AIG and the bailout of Chevrolet. Chrysler and Ford did not take the bailout, and that was actually in the second wave, I believe, and then it went on for 3 or 4 more waves. And we came out of that one, and we actually had a period after that, which you may or may not remember, where we didn't have inflation. One of the reasons that I remember this is I was doing Social Security workshops at that time, and Social Security went without any increase for 2 years. Now you're starting to remember that, right? Well, the government said that the reason they did not inflate Social Security is because inflation was at 0. Is it possible to come out of an economic recovery without inflation? Well, it happened then, but it is not happening right now. We're actually dealing with inflation right now that's insane, and I mean absolutely insane. Even the government is telling us its numbers are higher than 4%. Let me tell you, they've done studies on this, and inflation is different for retirees. Most of the people that listen to my show versus younger people are retirees. And if you think about it, for younger people, a large percentage of their income is going to house payments that are steady every month for 20 or 30 years, or they have a car payment that's pretty steady for 3 to 5 years. But retired people don't have that luxury. They don't have that stuff. They basically have paid everything off, and everything they spend money on is on inflationary items. If you have 50 to 75% of your money going into fixed payments, you don't feel the pain of inflation as much. You don't feel it like you do when you're retired. Healthcare alone is way over 7%, and that's an item that's cognizant in every one of our minds, especially if you're retired or getting ready to retire or living on required minimum distribution. The question that comes to mind is, will you have enough income in retirement? Is your income going to get sucked up by reflation, inflation, or whatever you want to call it? I'm going to give you something pertaining to today's topic. It's a commission report titled The Importance of Financial Defense. That's right, the importance of financial defense. And it takes a deeper dive into what I'm talking about on today's program. It's free of charge, and I would love to get that out to you. And the best way to get it is to call me at 1-800-FSG-7890. If you'd like that free report called The Importance of Financial Defense, give me a call at 1-800-FSG-7890. Today we're talking about reflation. That's kind of another way of saying inflation. So a quick story that literally just happened. I said to someone in the office the other day, for years we were told by the government that inflation was usually 2 to 3%, and we believed it. We knew it was probably low, but really you couldn't see inflation in front of you. Some of you that may have traveled to other countries that have inflation running rampant, or some of you that were investing back in the 80s when Jimmy Carter was president, remember seeing inflation happen right in front of you. Well, we're actually back at that point right now, and you can see it just at the gas pump. You can see it in clothing costs. Things are whacked out. It's like the Twilight Zone right now. I had a person in the office the other day told me he bought a new car a year ago and just sold it for $3,000 more than he paid for it. It's a supply and demand thing. I talked to a salesperson this weekend. He said, if you want to get a new car, you're going to have to wait 9 months. And people don't want to wait 9 months, so everyone is going to the used market. And there's not enough of those. So that's what I'm saying. Anyone with a used car, people are getting calls from dealerships wanting to buy your car. This is what we call hyperinflation happening right now. This is like living in some other country where you can see it right in front of your eyes. I have heard stories where you look for a pair of jeans in another country in the past and you come back the next day to look at the pair of jeans and the price increased overnight. That's what we're looking at right now. Let me bring this home for you. So what does that mean? That means if you're retired and you have a fixed income, and especially if you're on Social Security and you're taking some income out of your retirement savings, the good news is the S&P has been up. So it's probably been keeping up with what you've been taking out. But what if this inflation stays and the market goes south? If this inflation lasts much longer, the market is eventually going to go down. And what do you do when the market goes down and inflation keeps going up? You need to increase the amount that you're pulling out of your retirement savings, but the market is going down, and that's what we call a recipe for running out of money before you run out of life. I mentioned this a little bit earlier in the show, but I have a commission report that I'd like to get into your hands, and it's called The Importance of Financial Defense. And it basically takes a deeper dive into what I'm talking about on today's program about reflation. And it's free of charge, and I'd love to get that into your hands. So the way to get it is to give me a call at 1-800-FSG-7890. Again, that's 1-800-FSG-7890. And what that report's going to do, it's going to give you a better understanding of what I'm discussing on today's program. And I'll be sure to get that out to you if you give me a call. So next, we're going to be talking about what happens if this reflation is temporary or what happens if it's permanent.
This is the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona. Have you missed any of today's program? No problem. You can hear all of the RetireTastic Show online anytime, 24/7 at yourfsg.com. That's YOURFSG.com. Welcome back to the RetireTastic Show with JoAnn Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
Welcome back to the RetireTastic Show, and I'm your host, JoAnn Regan, where my goal is to help you have a fantastic retirement. And today our topic is reflation, and you didn't hear that wrong. It's reflation. I know it sounds a lot like inflation, but a little different, but it's really a thing. It's a form of inflation. We talked about the definition of it. It smells, tastes, and looks an awful lot like inflation. It's something that we're dealing with. And as I said before the break, we're seeing inflation happen right before our eyes. Most of us haven't really seen this before, and we've been told a number by the government, and we kind of took their word for it, but we really didn't see it. In the last year or two, we've seen an F-150 go up in price, but we're seeing it change daily now, even monthly. You're getting calls from your used car dealer out there wanting to buy your car because they don't have enough of them. It's just really odd. What really is causing this to happen is these are the types of things that happen when you shut an economy down for 2 months. That's why we haven't seen it before. Let's face it. I'm not going to get into the political side of should we have done it or not, but the fact is we did. And the fact is, I do believe for the very first time in American history that we've ever done it. I do know one thing. It was the first time the Ford plant has ever been shut down since Henry Ford. It took them quite a while to get that thing started back up again. Seriously, we weren't meant to be shut down. This is what happens when you don't do it as a country, you do it as a worldwide thing. Not everything we buy or make or get is made here in America. The entire world shut down for 2 months. We're now seeing the ripple effects. It's really, really an odd thing that we are dealing with right now. The problem is you can't get anything. If you order 3 things on Amazon, and well, Amazon is pretty darn good at getting stuff to you, but other than that, sometimes you may only get 1 or 2 of those things. So is this permanent or is it temporary? Well, the fact is we really don't know. Let me tell you what will happen if it's temporary versus permanent. Most economists and federal officials think inflation is a temporary blip. It's just going to be here for a short time. The Fed's own measure of measuring inflation is at the highest it's been in 13 years. The Fed is saying that this is temporary. If it is temporary, we're going to have to be dealing with this for another year or so. Ultimately, probably it isn't going to be a major factor in your retirement savings. Did you notice that the market went down here? That was due to the fact that the Fed talked about raising interest rates. And one of the reasons they're raising interest rates is they want to get ahead of this inflationary issue. They are trying to manually go in and slow it down. Hope it works. But what if it's not temporary? What if it's permanent? If it's permanent, it's really going to start affecting your retirement income. If you have $1 million saved for retirement and you're getting ready to retire, and you figure that Social Security and your $1 million that you're taking out, maybe a 4% withdrawal rate out of that $1 million, is going to get it done. Well, you may have to go back to the drawing board for it if it's a permanent situation with this inflation. One of the articles that I read on this topic, I was literally reading right from that article, and the fear is, what if inflation is not temporary? Then it's like the feds are pouring gasoline on a fire, and that could provoke a violent market reaction. That report went on to state that even if the feds have a slow reaction to it, the market could turn on a dime, and we could feel the factors of this thing going from temporary to permanent. That's the bottom line. Have we all not seen that the markets react faster and faster and faster? Well, there's a multitude of reasons for this. Online trading, just the fact that everyone has one finger on the trigger and scared. We're all enjoying that the markets are going up, but seriously, I want you to ask yourself, we are doubting whether or not it's going to continue. I want you to think about that for a minute. If you're 30, you probably don't care. Matter of fact, you're probably hoping that the market will go down so that you can buy lower. But if you're 65 or 67 and you have $1 million saved, you figure your Social Security is going to be around $4,000 a month between you and your spouse, and you figure you can pull another $48,000 a year, maybe $40,000 a year out of your $1 million. You add one to the other, and that's $80,000 to $85,000 a year, and you're good. You're getting ready to pull the trigger. Well, you have an advisor that's going risk on in all of your portfolio, and you've been enjoying some of the benefits of the market going up. Is your gut telling you that it may not continue? I know it does. You call me every week. We all think that. So let's think about that. What's actually making the market go up? Is it earnings reports? Is it that companies are doing better now? I know what it is. Not. I don't think anybody really does. Small companies are being able to hire people. The grassroots companies are doing much better. Yeah, that's why they're moving out of California. We know that isn't the case. I will tell you what's going on. We're getting man-made money pushed into the S&P 500, which is making it go up. The problem is it isn't real. We can see it. Can you really trust this type of economic growth? Also, the saying in our business, you can't bet against the Fed. Let me tell you something. It can turn and go south in a hurry. If what I've just talked about is on your mind and you're a little concerned about it, I'm set to answer any of your questions, and I can provide you with some more information. Why don't you give me a call at 1-800-FSG-7890, and let's discuss some of this stuff seriously, because I feel like I can probably give you some information that might be able to ease your mind. So today we're talking about a term called reflation, and I'm going to give you that definition again. Reflation is a fiscal or monetary policy designed to expand output, stimulate spending, and curb the effects of deflation, which usually occurs after a period of economic uncertainty or recession. Does that sound familiar? I like to call it good old-fashioned inflation, and it's happening right before our eyes. Earlier, I talked about that if it's a temporary thing, that's one thing. But if it's permanent, we have a problem. This is the RetireTastic show, powered by the Retirement Income Show, and I'm your host, JoAnn Regan. So here's the issue we're seeing right now. You go to buy anything, name it. Go out to eat. You don't even have to buy a material item like a Ford F-150. Just go out to eat, and you're seeing prices go up. Restaurants are having to charge more because they were shut down for so long. And if you're on a fixed income, which almost every retiree is, it's eating into your retirement savings. And if you're getting close to retirement, you're thinking, is this going to eat in enough that I'm going to have to go back to work? This is one of the main reasons that you hear me talk about on my shows of why you have to have a diverse portfolio. You have to have enough diversification because you have to have something that can offset inflation. You have to have something that can drive income. And you have to have a lot of different things inside there, maybe even some precious metals. No matter what your situation is, let me tell you one thing. Don't put 100% of your money into anything because there's no hedge against inflation. There are different investment things that you can do, such as annuities, which are fantastic for income, and a diversified portfolio that's invested for income. But you have to have some hedge against inflation, and that's why a diverse portfolio works best. So let's talk a little bit about what if this is a permanent change in inflation that we're dealing with here. What would happen if it were permanent? I often ask people, more often than not, do you think history has a way of repeating itself? And most people would agree that it does. So let's go back when this happened. Many people have been picking on Jimmy Carter. Jimmy Carter hasn't been called on in years, and now everyone is bringing up his name again because we're seeing inflation. I can picture poor Jimmy Carter saying, come on, man, I haven't been called on in years, and now y'all are picking on me. That goes back to when we saw inflation running at its most rampant. Amazingly enough, the market from 1977 to 1981, when he was in term, actually had a really growth rate of 6.9 or 7% per year. Yeah, that kind of surprised me when I saw that too. And it's actually about 7% a year. But here's the catch. You needed every single bit of that. And if you remember back when 7%, when it was that, money markets, what were they doing at that time? I actually remember clients telling me they were making 12 or 13% on their money market accounts. The market was actually way underperforming money markets. And here's the other catch. What were you financing your houses at? That was nuts. I don't know how anybody could afford a house back then. Now we're seeing the market up, and we're needing every dime of this right now because items are going up faster than the stock market. I'm going to just give you my educated opinion on what I think will happen if this continues for another year or two. We are going to see some major market declines. Hope Jerome Powell gets out in front of it and raises rates. And even at that, there are a lot of things that could cause things to go south. I'm not saying take everything and pull it out of the market. I'm saying having 70 or 80% in, if you're 65 or 70 years of age, is probably not going to be your most prudent plan that I can think of. Yet it all comes back to how it's going to affect your money in retirement, your income, because that's really what it's all about. And that's the whole premise of this show. How is it going to affect your income? Here are some things I want you to think about. When we saw what happened to the market in March of 2020, that was an anomaly. It was a V recovery. Jerome Powell didn't even think it was going to be a recovery. He thought it was going to be a W recovery, and I did too. The norm is that it will drop down, stay down for 6 to 7 years. That's what it does. It doesn't have any respect of any person. It doesn't care what your age is. You could be 90, it's going to do it to you. You could be 30, it's going to do it to you. Now, for a 30-year-old, you're in a position where you can take advantage of that. If you're 70 and you're taking money out of those retirement assets, it better not be the majority of your money. That's the biggest thing. Can you handle this kind of a dip? I had someone in my office last week and he said he could handle that kind of dip. And I said, okay, I just want to play this out for you. Say that you can handle a 6 to 7 year dip. I want you to picture this. The last time it went down that far, it went down about 50%. You would see $1 million turn into $500,000. You're not going to see this come back for 5 or 6 years. Living on Social Security in this, is that something that you really want to do? Probably not. Come on. People say that, but the fact of the matter is, unless you have someplace else to get assets and you're keeping a large pot of cash, is that really the best idea? I'm not a big fan. And I think you have to have items in your portfolio that will develop interest and dividends for you and basically pay an income during that time frame. Do I think you should take everything out of the stock market? No. However, I will tell you what I'm seeing. A lot of advisors this year are chasing yields. Markets are going up, take everything and put it in it, and that's all fine until things turn south. I've always said that getting an account to grow at a rapid pace does not take a financial genius. Anybody can do that. We found that out in the 1990s. It's getting an account to grow at a good clip and keeping safety paramount while you're doing it. The funny thing is that people are calling me now and telling me, yeah, growth, I want to see it. But my main thing is I want to see preservation of capital and I want to see interest and dividends. I want to see income out of that portfolio. It's not just about growth anymore. I've grown my money and now I want to keep it. So that's what my people are telling me. And that's what we do as a company. We keep the management internal. We don't farm it out to some random company. We try to put a little bit of everything in the portfolio and look at all the different asset classes. If you're finding somebody putting you in a full-bore market portfolio for growth and you're getting into your 60s or 70s, I have a book that I'm sure you're going to find very helpful. It's called The Common Sense Bull, and it's written by my friend and colleague, Eddie Gabor. And it's a very good read, and it will help you understand what I'm talking about. To receive this book, give me a call at 1-800-FSG-7890. That's 1-800-FSG-7890. Or if you'd like to speak with me off the air, that can also be arranged. I set aside time each week for all of my valued radio listeners. So please reach out, and we'll spend some time discussing your concerns and needs. Well, that's it for today. Thanks for listening. Please tell a friend about this program and check out our website, yourfsg.com. And I look forward to talking to you next week. Have a great week.
That's all the time we have for today. To speak with JoAnn off the air, call 800-FSG-7890. And for more information about our program, visit yourfsg.com. The RetireTastic Show with JoAnn Regan airs Saturday afternoons at 1 and Sunday mornings at 8:30. To speak with JoAnn off the air, call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com.
Investment advisory services offered by FSG Financial Services, Inc., a registered investment advisory firm in the states of Arizona, Nevada, and California. Sound Income Strategies, LLC, an SEC registered investment advisory firm, is a sub-advisor of FSG Financial Services, Inc. FSG Financial Services, Inc. and Sound Income Strategies, LLC are not associated entities. FSG is a franchisee of the Retirement Income Store. The Retirement Income Store and Sound Income Strategies, LLC are associated entities.